Okay, good morning, everybody. It's Monday. We are into week 9 now, and I want to just kind of real briefly talk about where we are and what we're doing, because we just finished up last time a discussion of Appendix F, which was a fairly brief particular module within the it's actually not written, but within the textbook itself. In fact, it doesn't even, I guess, according to the authors, I guess it doesn't even warrant its own chapter. So it's only an appendix, but it's sort of an application of a different method by which we sort of cost out manufacturing overhead, which is not always an easy thing to deal with. And we talked very early on in the course about some of the issues with manufacturing overhead and what to do with it, because these are indirect costs. They don't readily and obviously attach themselves to products, and sometimes they're sort of invisible to the end user as to what these might be. And so that was really one method. We're going to start on chapter 14 today. And one thing I will tell you is I went ahead and extend, or I'm going to extend the due date, the homework quiz bonus, to the 10th. And that also coincides with the next exam's due date. And that exam is going to be available on Monday. So and it's going to cover those last three chapters, 13, 14, and Appendix F. Or actually 13, Appendix F, and then 14. We're just sort of out of order here a little bit. And we'll talk more about the exam next week. It'll be available, and it just sort of pops up available in Brightspace on Monday. And but yet, obviously, chapter 14 is a part of it, and an important part of it. And we're going to be talking about that today. I think, just based upon my experience in this matter, that I'll probably be able to get through the content of chapter 14 by Wednesday. And then when we come back next week, I really would like to spend most of the day on Monday, or most of the class section on Monday, doing some example problems and exercises, because I really think that because there's a diversity of different kinds of problems that are really faced in incremental analysis, I want to give you a pretty good sampling of how to work these as you approach the homework quiz, then obviously the material on the exam. So I think that's an important thing for us to do. On Wednesday of next week, if I'm still sort of going over some of the back of the chapter exercises, I think we'll talk about the exam, and I'll do a bit of a review session. As I always tell people, bring your questions if you have questions about something, even if it goes back a ways, even in the first segment of the class. That's fine, because this material does sort of build on itself. And so if you have questions from in the Wayback Machine, go ahead and bring those to class next Wednesday. We'll review for that. And I know that pushing back this to the 10th sort of backloads some of the material to be done, but a lot of people work ahead and will finish this well ahead of time. I would not try to do it all on Sunday, Sunday the 10th. It's probably going to be a rough Sunday, but if you can space yourself a little bit, pace yourself, space things out a little bit, I think that's all to the good. Okay. Any questions for anybody either in the room or on the Zoom link? Okay. If you do have questions, you can either, if you're on the Zoom call, you can just give me a shout out, or you can put something in the chat box, whichever you prefer. Okay. All right. So, all right. Well, let's do this. Let's get into chapter 14, incremental analysis. So this is a particular segment of the class, and I really think, personally, that I think this is accounting at its best. I really do. This is where accountants sort of earn their pay, particularly when it comes to making decisions, or at least advising management as to what to do, based upon quantitative data primarily. And remember, one of the things about accounting, it's not really about the math. It's more about the sense of organization and logic and analytical skills, and that's certainly what's going on here. The math is not should not be the big impediment everywhere in accounting. And we'll talk about here in a second about quantitative analysis, but we'll also get into some qualitative. Accountants are not known for their qualitative analysis. That is saying, oh, if we do this, we're going to sacrifice the quality of this product versus that and all that. It's not really their area of mandate, but nonetheless, sometimes those issues do arise. And at minimum, management can be advised as to what to do based upon their own particular analysis. So it looks like this is a lengthy segment. It's not really that lengthy because a lot of these are sort of related to one another. But I do want to take some time just to sort of ease our way into incremental analysis and what it means. First of all, incremental analysis is this idea if we do a little bit of this, what are we going to have? We're going to have change in revenues, change in costs, ultimately a change in net income. Do we want to do this? Do we not want to do this? And a lot of these decisions really happen to be what we would call binary. That is, if I do one thing, I cannot do another. If I do this thing, I foreclose the opportunity to do something else. So therefore, I've got to make a decision. And decision making is a big aspect of management in general. But managers sometimes don't have all the facts together. They rely upon people who are crunching the numbers, putting together models to determine what is the right course of action. So in this module, we're going to be talking about this entire decision-making process, how it's arrived at, we're going to say it's arrived at in a logical manner, and we may introduce some ideas that may appear to be contradictory on their face, but as I hope we'll see, that it should not be that contradictory. We'll talk about what are the relevant costs. This is something we really haven't talked about before. Relevant costs are only those costs which we should consider in a specific decision. There's some costs which are not relevant because we're going to incur them regardless. A lot of fixed costs are not really relevant. We're not going to stop paying insurance on buildings because we're either ramping up or dialing down our production. It's just not going to happen. Or we're not probably going to fire the security guard because we're not working for a month or so while we retool or we retool to make some other product. So those costs will be considered not relevant and not part of the decision. We'll also talk about some examples. These are some specific case examples. Make or buy, that's a very common bit of analysis. And we'll probably get to more of that on Wednesday when we get into some specific examples. I think maybe we may get part of the way into this today. We'll talk about this idea of whether to sell or process materials further, and that is an interesting idea because and I think I mentioned to the class that there are occasions, particularly in the manufacturing context, where a company is producing a product and somewhere midstream, somewhere in the chain of value, they decide they can't do something very well, and they'll let somebody else do it, some independent actor do it, and then if it's done, they can ship the products back to them because of the fact that they can do it better, cheaper, and faster. And that has been a tenet of management, particularly manufacturing management, for many decades now. The work of Peter Drucker was, and I'll talk, unless I forget, I'll talk more about his idea of saying, if there's something somebody else can do something better, cheaper, faster than you, let them do it. Okay. We'll also talk about this idea of whether we repair, retain, and replace equipment. Probably get to that on Monday or Wednesday, and then we'll talk about the relevant cost as to whether or not to stop doing something. This is probably as important as doing something, and that is, what are the occasions in which we say, you know what, we're going to not do what it is we're doing. If we're making shampoo and conditioner, and we decide that conditioner no longer makes sense for us, maybe we stop making conditioner altogether. And business world is full of examples in which companies no longer do something because it simply doesn't make sense from a profitability standpoint. But how do you know if it's profitable or not? Because you've got all these costs, and you've got to be able to sort of separate them out and determine what are relevant or not. And until you make that determination, it's really hard to sort of know. And I think this is one of the reasons why some companies, particularly smaller businesses that maybe lack this expertise, get themselves into trouble, is because they're doing things that are completely unprofitable and they probably don't know it. And that's an unfortunate circumstance. It's an unfortunate business circumstance, but it does happen. Okay. All right. So let's get into, we'll talk first of all about what is this whole incremental analysis? And so spend some time talking about what's going on here. And remember, we're talking about a decision-making process that is aided by the sort of number crunchers. And by the way, I actually don't like that term. I can't believe I just used it, because one of the big ideas in accounting right now is that accountants really do not view themselves as number crunchers anymore. They view themselves more as consultants, as analysts, as essential parties to the decision-making process to provide all the facts so that senior management can decide what to do. Yes, it involves numbers, but it's not only about that. So decision-making is obviously something that usually flows to mostly to the top, whoever's got the authority to make decisions. And it is, as your text says, an important management function. And it doesn't always follow a set pattern. And one of the things about this is this, we're going to get into the budgeting piece a bit later in the course. But I know that we'll talk about budgeting as being sort of a one-time deal, once a year. And I know the companies that I worked for would always do the budgeting in the fall, like right around this time. They would spend a couple of weeks, and just, senior management would sort of hold themselves up in a place, and they would sort of put the numbers together, haggle, bargain, argue with each other to come up with things. But here's the thing. Sometimes things happen during an accounting period, the budget period, which define the budget, and we have to decide what to do. And there is an idea right now, and we'll probably get to this a bit more when we get to the budgeting section, this idea of continuous budgeting, that the budgeting process should never end. It should always be an ongoing kind of thing. It's an idea I think it's got a lot of merit. I personally agree with the idea. I think setting an artificial timeline doesn't make sense. So the idea that it doesn't follow some set pattern makes sense. And not all decisions are the same. Sometimes things are urgent, sometimes they are not. But the steps here are identify the problem and assign responsibility. Now, one thing as I looked this over, and I was preparing for class yesterday, I was thinking, I would add one additional thing to this, and that is I would establish a timeline. So if there's a choice, we have a choice A, B, C, whatever those are, we don't know what they are in this case, but I would assign somebody responsibility for saying, let me know what you think about this idea. But I would also set a time frame. One of the problems with assigning responsibility, sometimes we leave the due dates open-ended, and frankly, I've seen lots of cases in which people have been assigned things and they never get done. Nobody ever gets back to you. And it just is a loose end and nobody ever addresses it, and that's a problem. But I would give people a reasonable amount of time, but not all year, to make a decision and to assign to make some sort of determination, recommendation, whatever. And so identify what these courses of action are. We can do this, we can do A, we can do A, we can do B, we can do C, however many options. It can be unlimited within reason. And then finally make a decision. And then later, this is going to be after the fact, review what the results of the decision are. But I really think that assigning a sort of a timeline makes a lot of sense. And I know that when I was in management, we would see lots of cases in which people would be assigned things to do, and things happen during it. We're all busy during the day in the business world. That's why it's called business. We're busy, right? And things come up, and and there are days in business where you get nothing done other than literally, putting out fires in one place or another, dealing with angry customers, dealing with whatever, and your whole day is shot. And it may take several days. So I understand that. And that's why you have to sort of put a due date on these kinds of things. Okay. In terms of these, and I talked a second ago about quantitative versus qualitative. So what's going on here is the idea that from a decision-making standpoint, or providing information to assist the decision-making information, there's both financial and non-financial information. The financial information is similar to what we call quantitative, deal with revenues and costs and what the effect overall is on the bottom line of net income. And when we talk about this idea of incremental analysis, we're talking about incremental revenue where it exists and incremental costs. What does that mean? If we have a chance to sell $1 million of new product, that would be an incremental revenue. What would the incremental costs be? Those are the costs which would not be there would we not pursue this avenue. And so this idea of incrementalism says we're not reinventing the business, we're not building it back brick by brick, we're not looking at the entire picture, which is where I think a lot of people get a little bit confused here, that we're not capturing all the costs, just the relevant costs that are going to incrementally change if we pursue one notion, one avenue versus another avenue. So those are the quantitative, and that's probably, from the accountant's standpoint, the more impactful and bit of analysis. But there's also qualitative information as well. That is, if we do this, what is the effect going to be on employee morale, employee turnover? If we lay people off, for instance, because we no longer want to make this product, Remember, we're making shampoo and conditioners. We don't want to make conditioner anymore, so it means that workers are going to be laid off. That is obviously a very depressing effect on employee morale, and other employees may leave, and these may be employees we do not want to leave if we're a business. And so what is the effect there? Environment and company image will simply capture under the sort of the rubric of something called ESG, which stands for environmental, social, and governance issues. And I know we talked a bit about this in Principles 1, ESG. It's a big issue right now. And I had a conversation with somebody on Friday about the fact that ESG is really taking up a lot of the time of businesses right now, particularly their accounting staff. And obviously environmental concerns are important because there's has been now for some time a greater awareness that what business can do is sometimes detrimental to the overall economy. Yes, they're making a product, but maybe they are also creating emissions or pollution or wastewater, and whatnot, and that's a problem. And I grew up in an area, in the industrial Midwest, what we now call the Rust Belt, where I lived about half a mile from a fiberglass plant that used to just dump vast amounts of whatever. It was this foaming white stuff that would be smoking and foaming in the river, and then downstream all the fish would be dead. And also they also had water pollution and air pollution, and where my sister still lives there, and they were told by the EPA a few years ago that they can't drink the water. The tap water has been contaminated, and they said eventually the environment will clean itself up, and they estimated that would take 400 years. So obviously that's a little bit beyond our time frame. So environmental issues are important. When it comes to social issues, we're talking about treating workers fairly, and obviously there's a lot of concerns over child labor, particularly in parts of the world. That's one issue among others. Also equitable treatment in terms of having a diverse workforce throughout the organization, top to bottom, including board members. And so that's a big thing. And then governance concerns how a company controls itself, manages itself from the board level on down. Now, why am I spending time talking about ESG? It's not a key feature of this particular module. I understand that. But the point I want to make, though, particularly for those who are going to be accounting majors, is this is going to be bigger and bigger and bigger and bigger, and it's not going to get smaller at all. And in fact, I was on a podcast, listening to a podcast the other day that said that about a couple of years ago, they had at one of the big accounting conferences, they had about 100 people in the room for ESG issues. And the next year, they had over 1,000 people, mostly because of the fact that everyone is concerned about it, and accounting firms themselves and accountants within organizations, internal and external accountants, basically, are needing to deal with these kinds of things. Overall company image, and ESG is sort of that catch-all. So it's a big issue. The only reason I bring it up is because it is a thing it's coming on very rapidly. And by the way, the international regulatory environment is much more important. And on this podcast, I heard one accountant say that they were required by a European authority to create a greenhouse gas report about their emissions, and they didn't know quite how to do it. And so that's kind of an issue. Okay, we'll also talk about this idea of different choices we can make, and in looking at the relevant financial data, we're primarily going to be talking about the financial, not the qualitative, but rather the quantitative. So if we do one thing, we go route A, cost of revenues may vary, or only revenues may vary, or only costs may vary. And the thing I want to mention here, particularly in relation to cost, is it may not just be one cost. It may not be just the cost of production. It may be a lot of other sorts of costs that we really have to pay attention to. And if we don't pay attention to them, then I think we can make some real mistakes. And because it's not usually just one set of costs that are going on here. One of the metaphors that I have long liked is this idea of a kaleidoscope. And we've all seen little kaleidoscopes, little toys. You turn the wheel, all the pieces of glass, next colored glass change. They change position and whatnot. I think this is a relevant metaphor for what is going on here. Sometimes you make a change to one thing, and it isn't just revenues, one revenue stream changes and one cost stream, but maybe everything changes. That is the kaleidoscope, everything's moving around. And this is why financial modeling is so important, is in the sense that if we do one thing, what all is going to happen? It's a much bigger picture than what might meet the eye, because we have to understand what's going to go on with changes throughout the organization if we do one thing. If we stop making the conditioner, in other words, what does that mean? Does that mean we lose some confidence of our distributors, our customers who are retailers downstream? What is that going to do? These are things that really need to be taken into account. The kaleidoscope metaphor, I think, is something where we have to really understand the connections among variables. This is where the analytical skill set that accountants bring to the table in internal accounting and managerial accounting makes sense, and that is, what are the relationships among variables? And this is why sometimes we set up models, sometimes intricate, sometimes not so intricate, in order to determine what may happen if we do X, Y, or Z, okay? All right, any questions so far about anything before we move ahead here? So, okay, so as an example here, and this is just a very generic example. We don't know what the particular issue is. Hold on a second, I think I lost my transcript here. My captioning is not. The captionings, I lost my captions. Okay, so I think I've got it back. I don't, my captioning is, I have closed captioning on here so people can read the transcript. It doesn't seem to be, I just noticed it doesn't seem to be working, but anyway, I apologize. I'll see if I can do something about that. So, all right, so back to this. This is just an example. We don't know what the alternatives are. We just know we've got alternative A and alternative B, and what are the issues. And I like this particular example because if you do alternative A, you have actually a higher revenue stream versus alternative B. So it looks like, hey, it looks pretty good, right? However, the cost factor is A has $100,000 of cost associated with that choice, and B has only $80,000. So as a result, the change in net income is actually suggested that B is the alternative. Yes, there's less revenue, but there's also much, well, I wouldn't say much, but there's also less cost. And so what we want to do is get to the point at which we choose the most profitable alternative, okay? And so in this case, the option should be B. And I'm going to use a term that economists use called ceteris paribus. That is, all else remaining equal. It's a Latin term that says, if this is all that we know, and there are no other factors that we have not, that we failed to account for, then this would be the option to go with. And that's sometimes a pretty big assumption because we don't often know whether there are different options or not. We don't always know what the alternatives are and what the ramifications are. I think I have my caption back. Sorry about that. So it kind of bugs me when we lose that. So we're back. Okay, so ceteris paribus just simply means all else remaining equal. This is what we are looking at, okay? Let's talk a bit about these idea of costs and what we're really getting at. And first of all, we're going to talk about relevant costs, relevant revenues, and we're going to spend some time getting into that. I also want to talk about something which is going to play a role in this particular module. It's something called opportunity cost. This may be a new term to a lot of people, because I know a lot of our students have not yet taken microeconomics or maybe even macroeconomics. You definitely will come across this concept of opportunity cost in microeconomics. It's essentially this, it's the value of a foregone opportunity. And that is, if we choose one option, we have closed the door on doing something else. And so whatever the net benefit was of doing the thing we did not do should represent a cost so that we can decide what is still the best option. Opportunity costs, it's a challenging concept. Economists sometimes call this an implicit cost because these are not costs for which we write a check. These are costs that we incur by doing one thing and not another. And I know I've seen some econ texts in which there are some examples about people who've made choices and have foregone the opportunity to do something else. Tiger Woods dropped out of Stanford in order to play pro golf. And obviously, at least from an economic standpoint, that was probably a wise decision. One of the most obvious ones is Bill Gates, who was going to Harvard and decided he didn't want to finish. He decided he would move to Albuquerque and start a software company. I think we all know how that whole thing worked out. So he gave up the opportunity to do one thing in order to pursue something else. And so the value of a foregone opportunity. And a lot of times this value is either a cost savings or an increase in revenue or both. But it has to be factored into the analysis. Okay, and opportunity cost comes up in a lot of places. Let me just say one more thing about opportunity cost here, because I know that in financial accounting, the idea of opportunity cost is sort of viewed as being very suspicious, and it's not accounted for. If it's accounted for at all, it might be represented in the notes somewhere, where a company may say, well, we had a plant in Akron that burned down last year, and so it produced $25 million in contribution margin, and that's now gone because we've chosen not to rebuild that plant. So, but it's not a specific item on an income statement because it doesn't meet the characteristics of cost recognition in GAAP accounting. That is the idea of being measurable, identifiable, reliable, and so it doesn't fit there. So it's more of it's a nebulous concept, but it doesn't mean it's not real, because I think we always have to realize that if we do one thing, we are foreclosing the opportunity of doing another thing. I know that one time when I was in the business world, we presented to management 2 different plans. I think it was in marketing. I have rarely get involved in marketing activities. And we said, okay, we recommended plan A. And then our senior manager, who really was not a business person, frankly, he was a lawyer who was in the wrong job, I personally think, but very nice guy, very smart guy, but probably not in the right place. And he said, well, if B was such a good idea, why don't we do both? And it kind of defies the logic of why would we make a decision in the first place. He said, yeah, A is good, but so is B. Why don't we just do both? Well, I guess that's fine, other than the fact that you're going to involve yourself now in 2 things as opposed to 1 thing. So anyway, we'll come back to this a bit more. The only reason I'm spending some time talking about it is because a lot of the examples throughout this module deal with the lost value of something we did not do and how it becomes relevant to a particular avenue. Sunk cost is another concept we should talk about. Sunk costs are all around us. This is the spilled milk example. That we can't grab the spilled milk. It's done. Whatever the cost is, that cost is now no longer a relevant cost. And we're interested in relevant costs. That is, those costs which we can do something about, at least on the cost front. Something that's unrecoverable is one that's already been incurred, and we're never ever going to get it back. Okay. And some examples of things like that are, just to kind of give you an idea, these are costs that are never going to come back. And so some examples, and I'll just give you a few here, because we consider them to be not relevant and therefore not part of the picture. And some of those are R&D. There's been a long-running debate in the accounting world as to whether research and development should be an inventoriable cost. And FASB, which is our regulatory authority for external reporting, GAAP reporting, as long as that R&D should be expensed. And by the way, a lot of R&D results in nothing at all, nothing whatsoever. No product ever results from it. It's just a lot of research that simply never makes its way into a product, into profitability. And so those costs are always sunk. And I know some firms have been trying to lobby the regulatory authorities to let them capitalize these costs as part of the inventory, but it's just too indirect an issue for that to work. Also things like legal fees, frankly. And I know that we will put legal fees as part of the cost of an acquisition. Some of the examples we used in Principles 1 are we bought a piece of land, we paid $5,000 in legal fees, that becomes part of the cost of the land. I get that, but a lot of legal fees are not acquisition related. They're not ones that we can capitalize, that is, put into the value of an asset. A lot of them are simply fees that are gone, and they're long gone and they're never coming back again. Also things like consulting fees. A lot of firms hire consultants to advise them on different things. The consulting business has been big business for a long time. A lot of it is because of the fact that the business world is very complicated, and it's only becoming more complicated as we encounter new regulations and international issues, which are very murky and difficult for a lot of us to understand. Exporting consultants are necessary. It's very difficult, though, to tie those costs into a particular product and say, this $1 million we paid to McKinsey, which is a big consulting firm, has resulted in X amount of profit. It's just too difficult to do. It's kind of like R&D in that respect. It's just too difficult. Okay. Also, things like product costs for discontinued items. All those product costs, direct materials, direct labor, that we no longer are making, and if we've discontinued the item for whatever reason, this is the example where we no longer want to do something, then those costs are sunk and we just need to write them off. And then one big one here is advertising. And advertising, I had a brother who was in the advertising business for a lot of years, and he would talk about how wildly cyclical that business is, meaning if the economy takes a downturn, companies will cut advertising very quickly because it's really difficult to know to what degree advertising contributes to profitability. If it didn't contribute to profitability, nobody would do it. We would not have an advertising business. We would have substantial amounts that are spent, billions of dollars on advertising. But the problem is it's just too indirect. And once it's been spent, it's gone, it's done. And I've been involved in a number of advertising campaigns, not me personally, I'm not a marketing person, but I've seen advertising that just simply didn't work. And it was really just money gone. We have no way to apply it to profitability. We can't recognize it as a cost so that we can match up against revenue. And of course, we as accountants like to match costs and revenues together. So advertising is one example. These are all sunk costs. I'm sure there are others as well, but in the interest of time, that just kind of gives you an idea of what some of those are. What's the point though? The point is it's not a relevant cost. We're going to say that opportunity costs are relevant, but sunk costs are not relevant. And the reason why is because it doesn't matter, they're never going to be recoverable. We can't get them back. It's spilled milk, it's done. Okay? All right. Any questions so far about anything we've talked about here? Okay, let's talk about some other issues with regard to, yeah, there we go. With regard to costs, and then sometimes when we talk about incremental analysis, they involve changes that sometimes, and I like this statement, seem contrary to intuition. This is, I think, an important one because we're going to see some examples where it costs us $12 to make a product, and yet we're willing to sell a product for $11. Why? That doesn't make sense. Why would you sell something below cost? But we have to consider what are the relevant costs and what are the irrelevant costs in order to make that particular distinction. So sometimes this seems a little bit counterintuitive as we get going, so we have to look at that. Also, we have variable costs that sometimes don't change under various alternatives. Sometimes they do. It becomes difficult. And that's a counterintuitive issue. How can variable costs not change? We'll get to that, okay? Yet sometimes fixed costs do change between alternatives. And remember, we've already seen the case in which over a longer time period, fixed costs do change. And so we made the statement, some time ago, back in chapter 13, that all costs in the long run are variable. In the long run, all costs are variable. It's just that for a particular time frame, particularly for a budgeting period, a year, let's say, we can count on some costs as being fixed. If they change, they're not going to change very much. So, and they're not going to change with the level of activity. So as a result, they are considered fixed for that particular time period. But over longer term examples, these costs can and will change. Okay. All right, and then here are some of the decisions, and I'm sure there are many others that I haven't really thought about and haven't been included, and some of these get a little bit tricky, but these are some of the major events here when it comes to these. Now remember, these are sort of what we would call binary decisions. We do one thing, we can't do another. It's one or the other, right? And there are a lot of these ideas of binary relationships everywhere in life, right? These lights are either on or they're off. There's no half on, half off, right? You're either dead or you're alive, pregnant, not pregnant. I mean, you get the idea. There are some binary relationships where there is no middle ground. So we have to make a decision, and that's why we can't choose A and B. We have to choose A or B. And so what are the A-B type relationships? Do we do an order at a special price? This is very common. I'll talk a little bit about the example of price line and how it's sort of illuminated, I think, for a lot of people, the idea that sometimes the price is not really the price. And if it's a special order that contains a special price, do we decide to do it or not to do it? And we'll work through this very logically. We'll try to capture and understand what the incremental revenues are. That is, the revenues which would not be there if we didn't do it, versus the incremental costs which would not be there if we didn't do it, versus, do we just say no? And saying no is a perfectly acceptable thing to do. It's something that some people have difficulty doing, is saying, no, I'm not going to do that. I can't afford to do that. That doesn't make sense. And we're not going to do that. And Warren Buffett, the great investor, billionaire investor, has said that it's an important skill in business to know when to say no. I'm not going to do this. We're not going to accept this. And he actually sort of prides himself on his ability to say no to certain alternatives. So, particularly when it comes to negotiating the prices of companies he likes to buy and whatnot. And that would be an example of an incremental analysis. Make or buy is a very, very common decision that comes up. So that is, do we make or buy any of this or parts of it? And what parts do we make? What parts do we buy? Do we buy the whole thing finished and resell it? Or do we simply start from the ground level and make the products themselves? And there are a lot of different moving parts within this, because it's not just the finished product that we go from start to finish. It's maybe there are intermediate stages of manufacturing that we may or may not want to do and let someone else do it versus we do it. And that, I talked a bit about that earlier. Sell products or process them further. There's a really good example in this module that I like a lot. It's one that is easy to understand. It has to do with refining dairy products, and that is, do we stop? Do we stop at milk, or do we go on and keep making it a cheese? Do we stop at or making it a cream, like for, I guess, coffee cream, and then, or do we keep on going and make whipped cream out of it? Do we keep on going to make cheese? All these kinds of things. Or do we stop at some point and just sell the product downstream and let someone else do the rest, whatever they're going to do with it? That is an interesting bit of analysis, so we'll get to that. Repair, retain, replace equipment. That is, what do we do with equipment as it gets older? This is a big decision. And why this is big is because of the fact that equipment can be very expensive at times, and it's a big decision as to what to do. Do we repair something, or do we simply replace it? It's not an easy decision. And I know in my dad's company, they had a forklift the thing was banged up, and it was old and banged up, and they were always repairing it. And his staff would come to him and say, would you please buy a new forklift? We just keep repairing every month. We've got somebody coming out to fix this. And my dad was not exactly the most loose-walleted kind of person. He eventually gave in and bought a new forklift, but that was a pretty good example of the fact that if you don't replace things that are wearing out, all you do is repair them. Just like your car, at some point you're going to say, you know what, it's time. We got to replace it. Getting rid of unprofitable segments. I talked a bit about that. Some examples that I put were buy and lease. This is a really important one, and it's more important now because businesses sometimes don't want to own equipment or what we call fixed assets, furniture, computers, machinery. They don't even want to own the premises in which they live, and they would rather just lease everything. And when I was a commercial lender, I saw lots of companies that owned almost no assets at all, other than maybe cash and maybe accounts receivable. They leased the premises in which they did business. They leased the furniture. They leased the phone system. They leased computers because they don't want to own them. And sometimes there are some tax issues involved here as well. I'm sort of a tax person. That's sort of my area of specialty. And I kind of got a little bit weaned on that early on in my banking career, because leasing sometimes makes a good option. But it's not always obvious. Do I want to buy something, or do I want to lease it? And one of the elements here that should be considered, and it's beyond what we're doing in this 200 level course, is what are the tax benefits from leasing? Because sometimes if you lease something, you can write the whole darn thing off, every single dollar that you pay in the lease expense. And at some point, you got to give the equipment back. And at that point, you're probably ready to do that. And you don't want to mess with the product. It's just like leasing a car. You can lease a car, and at the end of whatever X number of years, you can give the car back. And you're perfectly fine with that. So that makes sense. Buy versus build, very common scenario, particularly if it makes sense to build particularly big facilities want to. And then when we talk about buy lease, what about sell lease? Do I want to sell a product or do I want to lease a product to somebody? And that's an important thing to understand as well. Just like there may be some tax advantages to buyers who decide not to buy, but rather lease assets, it can sometimes make sense if you're a seller to not sell the goods, but to lease the goods. And there may be some tax advantages, as in depreciation, because you still technically own the goods and you can write off depreciation. So these are all elements that come up. Anyway, I'm spending some time getting over in some areas that I'm giving you probably a bigger overview of this than what the text will get into. But all I'm really saying is, to me, this is where accountants can really shine and really earn their pay, is because of the fact they can sort of work through these options and find out what the best alternative is to present to management. And very often management will take the word of the accounting staff, the financial staff, and go with a particular recommendation, particularly if they're convinced that this is the best option. And there are all kinds of other options. A lot of times we set themselves up as one thing or the other. But by the way, though, when I say binary A versus B, it could be A, B, C, D, E, and you've got 5 options to deal with, but you still only have one option that you need to make a decision about. So yes, I know I presented as an A or B, I do this thing or that thing, but it could be multiple options, and sometimes they're all mutually exclusive in relation to one another. Okay. All right. Any questions so far about anything? Okay. Quick review question. Incremental analysis involves what? That financial data that do not change, or that change, or are mixed under the issue here. We're saying that they're the ones that change. Only the ones that change. And this is an important element. It goes back to this idea of what are relevant. We talked a bit about relevant costs. That is, those costs which disregard things which are going to be incurred anyway, but also relevant revenues. That is, revenues which aren't going to be impacted at all. So we're dealing only primarily here with relevant variables. That's really what's important. So here's a good example. So this is incremental. This example is O&T Corporation is considering 2 different options. We don't know what they are. It doesn't really matter. It's just we got 2 options, right? So here it is a true binary situation. The company currently operates under option 1. That's the base condition right now, with revenues $80,000 a year, maintenance expenses of $5,000, and operating expenses of $38,000. And I'm not going to actually work this out because the solution is there. I will do an example of another scenario here in a minute. The second option is the same revenue stream. So you're immediately thinking, I don't like that so much. We're already getting $80,000 a year in revenue, but maintenance costs don't go down, and maintenance costs go up actually $12,000 from $5,000, but operating expenses fall by $6,000. And so here's the thing: option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of $22,000. This would be considered a sunk cost. We incurred those costs. It's never coming back to us. It's money that's gone. So if option 2 is chosen, it'll free up resources that will increase revenues by $3,000. So complete the following table, and then also designate any sunk cost with an S. So, and again, I'm just going to go off of what the example in the text had for this. There is no change in revenue in either case, and so there's no net change to income, either up or down. Maintenance costs actually go up in option 2. Operating expenses come down a little bit in option 2. So you've got a little bit higher costs here, and so the negative symbol means it's a drag on net income. It's a down force, but it's also an up force here because you get about a $6,000 savings. Notice you've got the past equipment, which is completely irrelevant, and we're going to call it sunk. We're going to say it has no bearing at all on net income. It doesn't make any difference if we choose option 2. We still spent $22,000 to upgrade equipment, and so it's not relevant. We have to throw it out. This is not as easy a bit of analysis as what meets the eye, because sometimes people want to include expenses which are gone and say, well, but it's associated with option 1. Yes, it is associated with option 1, but it doesn't matter because it's already done. It's never coming back to us. Nobody's ever going to write us a check for $22,000. It's done. And then notice this, and this is where we get into some of the counterintuitive discussion, and that is option 2 would gain us 3,000 in revenue, but we put it as an opportunity cost in option 1. And that seems like, I know, and it, by the way, it'd be the same effect if we rolled it up to here and put 83,000, but we instead are including it as an opportunity cost here. Meaning, if we do option 1, we don't get that 3,000 in additional revenue enhancers. So in other words, it becomes a cost, not a revenue. And that's one that I think a lot of people, it throws a lot of people. I think some students in the past have said, well, you're just getting a little bit too tricky, a little bit too fancy by calling it an opportunity cost as opposed to a revenue. It really is not going to result in that much of a difference. But the idea is that we choose option 2, we're going to have an increase to net income from that particular option. Okay, even though no real effect on revenue at the present, and other than the fact that it would increase revenue by 3,000, but we include it as an opportunity cost here. Why do we do that? Why on earth are we doing this? Why are we getting so tricky with this? One reason why is because I think a lot of incremental analysis is built around the idea is, if I do something, what do I not get as a result? And I think this understanding of what the opportunity costs are is a critical piece of the understanding. I know that in GAAP accounting, we do not report opportunity costs, ever, really, for the most part. And economists will use those, but accountants are widely known not to employ opportunity costs in external financial reporting. But we're not doing external financial reporting, we're doing internal accounting. And so we are interested in the value of a lost alternative, okay? All right, so any questions about this segment before we move on and talk about the first of a number of different examples? And so where we're kind of going with this is the rest of today and into Wednesday, we're just going to be looking at different examples of where incremental analysis comes to play. And so one of these is doing a special order at a special price. And so let's take a look at that. So special orders, these are not in the normal course of doing business. It's an opportunity that arises sometimes very quickly, unexpectedly, and the company's going to make a decision as to what to do. This is why I think an important element that is not really brought out in the text, but I think deserves to be brought out, is the idea that somebody's got to make a decision, and sometimes quickly. And a lot of business decisions have to be made quickly because buyers of your good will put pressure on you. Hey, if you don't want to do this, I will find somebody else. But let me know. I mean, you've got until whenever, right, to do it. And so these are not open-ended opportunities. The opportunity is a window to jump through or not to jump through. Either go through the window or don't. So you have to make that decision. So in this case, they kind of come out of nowhere sometimes, and and oftentimes involve a major price concession to a specific customer or to a non-customer that you don't have. And without getting into some of the marketing and strategic management issues of saying, well, we'll do it at a loss just to kind of get this customer's business. We're not interested in doing something at a loss right now. I know there are sometimes those are some long-term objectives. I know a lot of companies when they're starting out will lose money year after year after year just to kind of grab a toehold into market share. But we're not interested in that. We really want to try to stay away as much as we can from the marketing implications. And for those of you who will study marketing, you will see some alternatives that may not involve maximizing profit, but that's what we're going to focus on here. It also assumes that if we sell the product, that it's not going to impact other products. Other products we make are not going to be cannibalized by what it is we're doing. In other words, and this is my word, no arbitrage opportunity exists. Arbitrage is simply an economic term that refers to the fact that people can buy things low in one market and sell it in another market. What we're assuming here is that we're not selling this to some buyer who's then going to turn around and sell the product at a higher price. Because if they could do that, we could do that, so we could cut that out. One example of arbitrage, it oftentimes is associated with finance, where you could, if you buy a stock for $20 in one market, you could sell it immediately for $20.30 in another market. All arbitrage opportunities are simply buying and selling almost simultaneously in order to make a profit. One example of this is people who will sometimes go to like auction sales and estate sales. People who've died, they buy furniture. A lot of furniture dealers, antique dealers will buy old furniture and old knickknacks and whatnot, and then take them back to their business and immediately turn around and sell them for a higher price. We're assuming there is no opportunity for that. No reseller opportunity. Okay, this is a one-off. And by the way, just to make this this point clear, your text will use examples like foreign buyers. So it's not so that we have locked out the opportunity of arbitrage or reselling it at a higher price. We're also assuming, this is a big one, which is why I underlined it, assumes the company is not operating at full capacity. This is an important consideration because we're going to say that most fixed costs are not relevant, particularly in a special order decision or make or buy or whatever, and that we have the opportunity to take this special order on without doing what? Without adding on to additional facilities, without having to buy new equipment, without having to hire new workers. All these are important considerations, okay? And as an example, I pulled up the Priceline website, and just to take a look here, and if you want you can probably find this, Google this easily, but the idea of Priceline is something that I think is a good example that sort of shows us that special pricing can exist. Priceline's business model was based on the idea that airlines and hotels in particular, had excess capacity. They could sell more seats on a plane. I mean, they're going to go from Cleveland to Detroit or whatever, whether there are 40 people or 100 people, as long as they've got 100 seats, right? And if there are extra seats, then why not sell them even at a lower price? Okay. Now, I know airlines would not want people to sort of wait around in order to get the special price. But if there's excess capacity, why not sell them for the airline's benefit? Because they're not going to get sold otherwise. Or hotel rooms, which are empty. They don't make money. One of the metrics that we talked about in chapter 13 was this idea of revenue per available room. That's one of the metrics that hotels like to use. And rather than rent the room for $150 a night, they may take $100. Why? It's $100 they wouldn't have had otherwise, right? Particularly if there's no extra cost involved in servicing that room and whatnot. So that was the idea of how Priceline started. And the term Priceline itself is a business term that basically says, what is the bottom price that a seller will take? That is our price line, okay? And so what they simply did was to approach the airlines and the hotels. And this article I really like, and I can send you the link if you want, talked about the great skepticism on the part of airlines and hotels to do this, because what they don't want to do is sell products below the desired price that they have in mind. But why not earn a little bit of incremental revenue if you're the hotel by renting to people who wouldn't buy otherwise? And in economics, we call this price discrimination. That is, and price discrimination sounds like a real negative term, like someone's being taken advantage of. And that there are elements of that, true. But there are also elements where you get special pricing because you wouldn't have gotten the revenue unless you offered special pricing. Things like seniors discounts, And my mom used to go have coffee at a place that gave her a senior discount. If she didn't get the senior discount, she wasn't going to buy it. She would just leave, right? Things like matinee pricing. It's a different kind of customer who goes to matinees, usually with children, usually with families. They don't want to pay the full price to go at 8 p.m. So matinee pricing is a way to price them in. And why not? I mean, there's no extra cost to have people sitting there at 2 p.m. Versus not sitting there at all. So that was sort of the logic of this. And so I bring this example up of excess capacity because it's an assumption that a special price can be accepted if it makes sense, if the incremental analysis of revenues, incremental revenue, incremental cost makes sense. But also if you've got excess capacity, why not, right? Use that capacity to do something else. And this is why when in economics, we talk about this idea of capacity utilization. And it's sort of a rule of thumb, has been for some time, that 85% capacity is considered full capacity. Well, 85 is not 100, right? So where is that? What's that 15% dedicated to? It's dedicated to the idea that maybe it can be freed up for things like special orders, rush orders, things of that nature. Okay, so anyway, I bring that up because I think it makes a lot of sense for what we're trying to discuss here. Okay, all right, let's kind of move on here a little bit and talk about the example. So the example that I just talked about, in fact, I used the same dollar figures, was a company that makes smoothie blenders, okay? And they're producing currently 100,000 smoothie blenders per month, which is 80% of factory capacity. Again, they have some excess capacity. And a lot of organizations will build in extra capacity just to be able, not only just to handle long-term growth and be able to grow into capacity. And by capacity, I mean labor, machinery, facilities, storage, warehousing, shipping, trucking, all those kind of things that go onto that. And if they have extra capacity, that's good for them. So there is 20% capacity available. Variable costs are $8 per unit. Fixed costs are $400,000. $400,000 divided by 100,000 units is $4 per unit. The smoothie blenders are normally sold directly to retailers. Remember, a lot of manufacturers don't sell to ordinary buyers like you and me. They sell to retailers or maybe to wholesalers. Some of that's changing with the internet, where you can buy directly from a manufacturer, but for the most part, the traditional model was selling to retailers at a price of $20 each. In other words, that's a wholesale price, right? Kensington's is a foreign wholesaler, and again, they sort of put in this foreign example here just to make clear the point. They're not going to be resold in the same market at a lower price to cannibalize this Sunbelt company sales. They've offered to buy an additional 2,000 blenders at $11, not 20, but 11. So the question is, well, what do we do about this? And so management's made the determination that they would not affect normal sales. What we call cannibalization is we're not just simply taking away our customers. This is something new, something different, something additional. It's not going to affect our normal customers who are unaffected, could care less about it because they don't know about it, and that we can do with that increasing factory capacity. That is, we don't have to build new facilities or whatever. Okay, so you think about it, you think, okay, well, it costs $12 to make a unit, $8 variable, $4 per unit. So that doesn't sound like a good deal. It costs us $12 to make that product. And we've been saying this again and again. One of the purposes of managerial accounting is to help management determine what it costs to make a unit of output. And we're saying it's $12. But now we're considering selling at $11 at $1 below cost. Do we want to do it? Do we not want to do it? Here's where we get into incremental analysis, which can maybe answer that question. So we've got two options here. We can say no, reject the order, or we can accept the order. So $11, 2,000 units is 22,000 in revenue. So we're going to have a boost to net income of 22,000. But here's the kicker. The costs are going to be considered $8 per unit times 2,000 units, 16,000, not $12 per unit, because why? The fixed costs are not relevant. Why? Because we're going to incur them anyway. It doesn't make any difference if we reject or accept. We're still going to pay whatever those fixed costs are. Meaning what? Factory supervisors' salaries, all those things which are considered to be fixed. Insurance on the building, it's not going to change. Property taxes on the building, it's not going to change. There's nothing we can do about it. In the long run, yes, maybe we can make some changes, but in the very short run, which is sort of where we live here, nothing's going to change. So in this regard, the change is 20,000 increase in revenue, incremental revenue, $16,000 increase in incremental cost, gives us a surplus of 6,000, surplus to net income. So as a result, it looks like this might be something we should consider. And it's something that's particularly relevant here in the sense that we've got the capacity to do it. We're not interfering with our own customers' business. None of our customers are going to then be buying this good at whatever the market. They sell for $20, right? Normally, and it's not like this company is going to take these goods that they paid $11 for and sell them for $15 to our existing customers. And we've got to be clear about that. One of the things that is always a concern among sellers is the idea that we try to keep buyers apart. I know it sounds like a terrible thing to say, but sellers oftentimes don't want buyers to be communicating with one another and seeing what price they paid and all that. it's just not usually a good business outcome when that happens. And so in this case, segregating buyers is a logical thing. In this case, the point was made in the sense this is a foreign purchaser, another company, and that makes so that might make sense to do. Okay, so that's sort of an example of what is going on here. Okay, and so in this particular, so that's one example. So it looks like we should probably do it. Another example is this one right here, and in this case, what do we got? This is a different example, and we've got a company called Cobb Company. They incur costs of $28 per unit, 18 variable and 10 fixed, to make a product normally selling for $42. A foreign wholesaler, again, they're making it very clear there's no arbitrage going on, offers to buy 5,000 units at $25 a piece, not 28, which is the normal price, but 25. And it's going to result in some additional shipping costs, which are going to be factored in down here. And we're asked to compute the increase or decrease in net income Cobb realizes by accepting the special order. So if I'm management and I'm contemplating either doing this or not doing this, I would ask the accounting staff to put an idea together. And they would use spreadsheets and they would put this together. And it's a heck of a lot easier to do in Excel now than anywhere else. If we reject it, nothing changes. There's no change to revenue, cost, or net income. If we accept it, we're selling 5,000 units at 25 a piece, which is 125,000. That's the incremental revenue from that decision. We're also going to incur costs of 95,000. 90,000 of it is the $18 variable times the 5,000 units, which is 90,000, plus the extra $1 per unit in shipping costs. So 90 plus 5,000 is 95. So it's going to give us an increase. It's going to give us an additional net income of $30,000. Again, the $10 fixed cost per unit is considered not relevant because it's going to be incurred anyway. So it's not something that we're really interested in. So, and here's the thing, you could even say, look, as long as we are theoretically above zero in terms of net income, we should do it, okay? We could even accept about 30,000 of additional cost in order to sell at this particular price. And I say that given the fact that it's one of those, what we call ceteris paribus, all else remaining equal. If this is all we know, and there are no other factors that we do not know about, yes, we should probably go ahead and sell this product at $25 each, even though we sell them typically at $42. It's a special order. We didn't see it coming, so we should accept the order. Let me just say one thing about this, though, just to sort of put this a little bit in perspective. And that is, we're also assuming that the company itself, Cobb Company, does not have very hard and fast objectives for things like profitability ratios, like return on equity and whatnot, because they're obviously taking a lesser price. They're diluting their return on equity to do it. Even though it makes sense, it adds to profitability and it doesn't add any incremental cost beyond just the addition of the variable cost associated with it. We're not buying new equipment, we're not adding new people. We've got the capacity to do it, and so we might as well do it. But sometimes there are conditions in which management is very firm. This is the ROE that we've got to achieve. And by the way, too, and I can tell you this for sure, that sometimes bank lenders will mandate in loan agreements certain financial ratios. And I know when I was involved in that when I was a lender, and we would sometimes say to creditors, we wouldn't say it, we'd put it in writing, you have to maintain a current ratio of this, right? Remember, current ratio from back in chapter 10, or ROE, you got to have this, because it's part of the requirement of maintaining the loans. And we would often, particularly when it's a very complicated loan transaction, and we wanted to keep them on a very tight leash, which banks often do, which is why a lot of people have trouble with banks, is because they are sort of on you when you owe them money. Make them do a monthly certification of this, that they're maintaining these ratios, and do sort of a non-GAAP financial statement, that they could do themselves. We didn't usually require to go to a CPA. They're certainly not audited, but there would be loan agreements that say you've got to maintain these kinds of things. This is not an irrelevant thing. So sometimes it's an important thing, and oftentimes these requirements will hinder a firm in what they can do. Part of the reason why that's there, frankly, is so that management and owners of the company don't yank out all the equity of the company for their own purposes, because they can do that. They can just simply do a special dividend or take it out, maybe in a loan to shareholders, doesn't matter. They can withdraw equity, and nobody wants that. Everyone wants a company that's well capitalized, particularly if that bank is a partner in providing debt financing. Okay. Before we leave this segment, any other questions? I've got about, let me see if there's anything in the chat box before I move on here. I don't see anything. So no, I don't see anything. We only got about 5 minutes, and I want to just sort of introduce a little bit of where we're going in the next set of decision scenarios, and that's the make or buy decision. This is a classic example of a company's being confronted with the question of, do I make something, do I buy it? How much of it do I make? How much of it do I buy? Do I make none of it and simply turn around and all I'm doing is a reseller of finished goods? It's an important distinction. There are a lot of different ways of looking at this, and so we'll get to an example. So first example, I don't think I'm going to have time to really finish this particular example, but you've got a company called Baron Company. They incur the following annual costs in producing 25,000 ignition switches for motorcycles, direct materials, direct labor. And here, we're going to split up overhead into variable and fixed, which I don't know that we've done yet in this course. We've talked about variable versus fixed cost generally back in chapter 13 when we got into CVP. We weren't really interested so much in product versus period cost. We were interested in variable and fixed, but it is a very useful bit of analysis to take the overhead piece of product cost and divide them into variable and fixed overhead. So what are examples of variable overhead? Things like electricity, indirect materials, certainly. Fixed overhead would be things like the supervisor's salary or the quality control inspector's salary. Depreciation, those are all fixed. And again, they're not largely relevant. So you got total costs here, you get direct materials, direct labor, the two pieces of manufacturing overhead give you product cost of $225,000 in total, producing 25,000 switches. 225 divided by the 25,000 gives us $9 per unit. So in this case, the scenario presented is, instead of making these switches, they might just simply buy them as finished goods somewhere. Who knows? Maybe a different country can make those better, cheaper, and faster. And a lot of companies will source foreign-made outputs and simply resell them. It's a different market, so the seller doesn't care. And a lot of times, there are a lot of parts of the world in which labor costs are far, far less, regulatory costs are less, all those kinds of things. And so they could buy the 8. Cost them 9, they can buy them 8. Should they do it? And if they do it, they're going to eliminate all the variable costs, including variable overhead, and they're going to eliminate 10,000 of fixed costs. So should they do it, or should they not do it? So in this case, it's already worked out. I'm not going to. I'll just go through this real quickly. So in this case, all right, if they continue to do what they're doing, we already saw the costs are 225. That comes from the previous analysis. If they buy them 25,000 units at $8 is 50,000, so that's a cost. And then I'm sorry, it's 200,000. Oh, and then they're lowering the fixed cost by 10,000. So okay, you should probably say variable costs actually, but anyway, let's kind of go with the example. So in this case, look, they're paying 200,000. That's almost what they're incurring to be able to produce them, and they're still going to have some fixed cost. The reason, actually, maybe this is correct, because the reason that these fixed costs are there is because they're still going to be incurred, and they're not doing away with them. They're only saving 10,000. So in this example here, they're actually $25,000 worse off. So in this particular example, this is the one in which we're saying don't do the proposed solution. Stick with what you're doing. It's cheaper. If you can get it for a lower price, get it down to $7. We've got a different scenario altogether. Okay. All right.
That also ignores though, like somebody has to buy them, they have to receive them.
Yeah.
So, like that's labor they have to pay for, right? Like, is that I assume that's accounted for.
Well, yeah, I'm assuming it is. I'm assuming it is, or I'm assuming it's not particularly material, and so we're not really terribly worried about them. I think you're right. I think that this is a perhaps oversimplified example where, yes, we would probably have to have somebody to account for them and count the beans and all that good stuff. So that's probably true. We're also ignoring what's probably going to be fairly substantial freight costs, I would imagine. And that's always a big, and freight costs are inventoriable costs. They would be part of the purchase price. Now, maybe it's baked into this. I don't know. Freight costs are almost all, if it's freight in and the buyer is paying it, which in this case we would be the buyer, it would be part of the inventory cost itself. Maybe that's in there. I don't know. And maybe the cost you're talking about is also baked in. So again, this is maybe an oversimplified example because we would want to include all the costs that are relevant. And sometimes, by the way, these scenarios get very, very intricate as to all the various issues that can come about, including things like foreign taxes that might be a part of the picture. And by the way, we have one of the presidential candidates talking about lots of new taxes on imports. And if this is an imported good, then that could be an issue as well. But that's maybe slicing a little bit too thinly here. So anyway, looks like we're out of time. I think I've gone over a minute or two, so I apologize for that. So when we come back on Wednesday, I will pick this up. We'll come back to the make or buy example. We've got a couple more things to do there, and then we'll talk about what I think is a really interesting discussion, which I want to make sure we take enough time to get through it. That's how far along the production process do we go? Do we stop? Do we create things and stop? Or do we keep on going to get some new final product? Okay. Have a great rest of your day. See you on Wednesday.